Okay, good afternoon, everyone. My name is Gonçalo Moreira. We'll cover another topic of the trade plan series, position sizing. It's the same topic we covered the last time, my last webinar with you a couple of weeks ago. But today it will be slightly different, the session, because we will have more interactivity. We'll do an exam together, a sort of quiz or exam. It will consist of 16 questions around the topic of position sizing. And hopefully we will also, for those who haven't been there the last time, we will be able to cover the topics in a way that you are able to understand the concept behind. All right. So we will basically, what we'll talk about is about variants of the fixed fractional model. So there are many models, more than the fixed fractional one, but we will focus here on the variants of the fixed fractional. We'll also explain what fixed fractional is. And today, besides of links and references, we will focus very much on the interactive quiz and also questions and answers. So basically, what we started doing last time was to define where the position sizing, where it fits within the money management, what is so-called the money management, which consists about risk control measures, position management techniques, which is another interesting topic, and position sizing formulas, which is the topic that we are covering. So money management is really a very vast topic, and it covers from position management, from risk control measures, and so on. And position sizing is only one side of it, one part of money management, but it's very wide, very versatile, very creative, and also quite easy to apply, since it's not about analysis, it's not about, nothing to do with forecasting or analyzing, but it's simply apply a formula. So it's practically the most easy part of the whole trading plan is to apply the position size. Money management as a whole is not meant to replace a strategy. That is why we have not started with this topic at the beginning. We have developed a complete strategy. We have tested it. We've verified the concepts behind the strategy and so on and so on. And now that we have a strategy proven, back-tested, we are able to face this topic. Money management is also not meant to turn a losing strategy in a winning one. So you need at least a robust strategy with a positive expectancy, and you can then enhance its performance with position sizing. And but you can't enhance the trader's execution skills, which are more a question of training and psychological control, so to say. So there are things that can be done, a lot of, but you can't do miracles with position sizing. Okay, so money management should be used to enhance the efficiency and robustness of a trading strategy, only if it has been proven effective, as I said, and it should be used as a capital allocation framework, allowing you to control the size of positions accordingly to your goals and risk profile. Okay, we have seen also position management techniques like averaging up, averaging down. We have seen categorized position sizing and martingale and anti-martingale types of position sizing, and we started by covering different position sizing models. And the first one, to compare the fractional position size with, we started with a fixed lot, which is basically you trade always with a fixed lot size, with a constant lot size, so that no variations appear. Okay, let me just jump here and switch the cam to the exam. And I would suggest we start with the exam. 1 second. Camera on. Do you see the exam window? Can you just confirm it to me, please? Because I have it on the front, but yeah, okay, fine. So this is the assessment. Let's just start. We have a passing score at 50%, so it will be, I guess, not too difficult to go over it, and we just allow the system to proceed. Let's start with the first question. The first of 16 questions asks, the fixed fractional model is a martingale money management technique or an anti-martingale money management technique? So we have question A and B. I ask you to type the answer that you estimate as correct, and in the end we'll see the results and all the explanation behind each one of the questions. Okay, anti-martingale, I see. The anti-martingale is particularly a model where you add to winning positions or after winning positions, and you decrease the size after each loss. All right, so we type B here and jump to the next question, 2 of 16. Which type of money management model favors a more rapid recovery from a drawdown? Martingale models or anti-martingale models? You see, a drawdown is a series of losses. In the equity curve, it's seen as a valley. Okay. In order to recover from a series of losses, do you need a model which adds position size after losses or after wins? Which model would recover faster from a drawdown? We have a question here. We have an answer from Andre pointing to answer A. Are there, Mark? That is, imagine you are on a series of losses and you want to recover fast. Okay, I'm not in here to give a preference to one or the other. It's just for the understanding of both concepts of martingale models and anti-martingale, but the ones which are based on the concept of rapid recovery from a drawdown. Adam says martingale simply not works, and that is true. But if we examine the nature of the concept, on which martingale is based, so martingale basically adds to the position size after each loss. That is why you need an endless, theoretically, you will need an endless capital amount to succeed with martingale models. Okay. I see we have here two answers pointing anti-martingale. Well, I have two answers pointing to anti-martingale, but I myself also answer A. I think we are majority by answering first answer. Okay. And we jump to the next question. It says, to determine the fixed percentage fractional size of a position, a trader needs the following information. How much money you have to trade? What percentage of your money you are willing to risk? C, what is the distance between the entry price and the stop loss for every trade? D, what is the correlated market risk? And E, what is the pip value per standard lot of the currency pair traded? In order to calculate a fixed percentage fractional size of a position, you need several elements. There are several variables within the formula. Okay, here you can choose several answers. Okay, So you need to know how much money you have in your account, for instance, okay, or what percentage of your money you are willing to risk. I think the question already answers to this one because it asks for a fixed percentage, fractional size of the position. So B is in. I see you answer also to the B. Harley says all of them. C, there are two people giving C as an answer as well. E, the PIP value. Andre says P, C, and E. Alex, B and C. Okay. And FX Trader, A, B, and C. So we point the A as well. Anyone for D? Harley is you point for D as well. Okay, so I type that in, and we choose all. A, B, C, E. So the majority answers A, B, C, E or B, C, E. Okay. Okay, let's answer like this, and finally the results will tell us which ones were correct. Okay, some traders perform poorly if their accounts start to grow exponentially. In which money management model do they find an ally for their trading style? So imagine, and here we will go, let me switch here the cam. 1 second. Okay, here you should see now the PDF again. Okay, you see an equity curve, right? This equity curve is the strategy that we have been talking about in previous webinars. The strategy that we developed from scratch, the strategy that we afterwards back tested and so on. And here we have the results over 5 years of trading with a fixed lot. Okay, trading always the same lot size, and you see the equity curve is quite straight. It's an ascending curve, can be supported with a linear with ascending line. Okay, and in a difference to a fixed lot size, we have here the results. You see the traded results in dollars are practically always the same result. And we have the trade results in percentage decreasing because you are trading always the same size. So in relation to the growing equity, the results are in percentage less and less. So you have this triangular shape of the trade results in percentage. But then you have this type of curve, this exponential ascending equity curve, when you work with a pure fixed fractional model. Okay, you see that the trade size keeps increasing, and also the results. Also drawdowns get more severe with bigger position sizes, and you see this ascending curve. So the question was addressing this type of results. So there are traders who have manifested a difficulty when the trader results achieve very high performances. A difficulty to handle with that type of position sizing, because the formula used, the pure fixed fractional formula, asks for adding to the position as the account grows, because you are risking, although you are risking a fixed percentage in terms of capital, you are risking a more and more. so that the resulting position size is also increasing, and this again increases the impact of each trade on the equity. Okay, and this may cause some difficulties. So the question here addresses precisely this problem. Show back here to the. Can you see? Let me see. You should see again the. Oh, it's off. You should see the exam again, right? Oh. Okay, now. So the question asks, some traders perform poorly if their account starts to grow exponentially, as in the curve that we just have seen. In which money management model do they find an ally for their trading style? The fixed fractional money management, the fixed ratio money management, the fixed lot money management, or the Kelly's percentage money management? There are some elements here which haven't been covered. Also in the last webinar, we haven't talked about the Kelly's percentage, and we haven't talked about the fixed ratio. So just if you know the answer, just the video is not good. No camera, sorry. 1 second. I try to put the camera on again. Okay, sorry. Okay, so you can see the question addressing which model could work as an ally for a trader whose account starts to grow exponentially. We have the fixed fractional, which, as we have seen, is the one causing the problem of rapidly ascending equity curve. So question A, we can exclude being the right answer. But then we have the fixed ratio, we have the fixed lot, and we have the Kelly's percentage. Which one would be Erin answers B. Let me type in. As we have seen in the curve was basically on a linear ascending equity curve. And we have also the fixed lot by Yaki. Okay. Okay, we can also choose one. We can choose only one answer, I see. Otherwise, we are adopting between C and B. Do we have anyone voting for one of these? Okay, if not, then I type C, as Yaki has been the first in answering. Okay, let's move on. An anti-martingale type of money management technique will require that the trading system has a positive win rate, expectancy, payoff ratio, or drawdown. So we have an anti-martingale. We can say now that to the anti-martingale type of techniques belong all the variations of the fixed fractional. Okay, all the variations of the fixed fractional are anti-martingale type of position sizing models. Okay, we have C, B, B two times B. Okay, expectancy. Fine. All right, let's submit the answer. And the next question is, when applying the periodical fixed fractional model and trying to recover from a drawdown, how do the time periods affect the recovery? Basically, what we have seen when describing periodical fixed fractional was that the fixed fraction is calculated the same way as in the classical fixed fractional model, but we wait for a certain amount of time to recalculate again the position size. So we set a priori, we set a length of time. Let's say we set 1 week, 1 month, or 3 months time, and after this time, we based on all the elements needed to calculate the new position size, such as the account size, the fixed fraction to risk per trade, the pip value. All these elements are used then to recalculate the new position size after a certain time. Okay, so when we apply this technique and we need to recover from a drawdown, how do the time periods affect the recovery? Longer time periods help to recover faster from a drawdown, or shorter time periods help to recover faster. So we have here the majority voting for B. Okay, right. So we have a drawdown and the shorter time periods to recalculate the position size helps to recover faster. Okay, let's submit the answer. And the next one asks, the periodical fixed fractional model, variant of the fixed fractional one, adjusts the risk percentage after a certain time if the account equity has changed, for example, after 1 day, 1 week, or 1 month. One of its characteristics is that it breaks the geometry of the equity curve. Okay. We have a true here. Does it break the geometricity of the equity curve? True. Okay. We will see an image comparing a geometric curve in a minute. Let me submit the answer. And the next question asks, select the image showing an arithmetic growth curve. Which one? Let's say this is A and this is B on the right side. Which one shows an arithmetic growth curve? A. Andre, Yaki says A, Alex as well. Tushar votes for B. We have a majority answering A. So we click on the A and submit the answer. Which way of stacking trades, also called pyramiding, which prevent bigger losses if a sharp retracement occurs against you? Okay. Answer A says, using always the same size for all positions, sizing the first trades with a bigger size, or C, sizing the last trades with a bigger size. So imagine you are stacking trades, you have identified a trading range within to capitalize with, from point A to point B, and you divide that distance in different stacks, and you put on different entry limits, for example, or entry stops. You want to stack into that position until your target is hit. But imagine that during that the trajectory of price, there is a retracement. So which way of stacking trades would prevent bigger losses? If you start by placing more size to the first position, those that are closer to your starting point, or those which are closer to your target. We have 2B, 1C, 1A, and 1B. I think we have 3 times B right here. Okay, so we choose the answer B for that one. And the results will show and explain which one was right. Does a fixed lot position sizing allow the trader to maintain a constant leverage? Are you able to maintain a constant leverage with a fixed lot position sizing if you trade always with the same lot? This question brings us back to all the elements that should be considered when we calculate the position size, right? Is the leverage? I would add to the question the effective leverage, the real leverage. Is the real leverage able to remain constant? Okay, I see the majority answers no. And we submit the answer. Does the fixed fractional position sizing model remedy the problem of equity drifting out of proportion in relation to the fixed lot size? We have seen a similar case here. We have seen those 2 types of equity curves in the fixed fractional model and the fixed lot size. Here is asked if the fixed fractional position size remedies the problem of the equity drifting out of proportion. That means that each trade size becomes very big in size because you are trading with a fixed percentage or a fixed fraction of a growing equity, of a growing account, and that growth may bring the equity out of proportion. Okay, I see we have the majority answer no, I think here. Right? 3 times B, 4 times B, and 2 times. Okay. All right, we submit the answer. By always risking the same percentage, you can make a profit even when the total net PIP amount is negative among several trades. Is it true or false? If you risk always the same percentage, can you make a profit even when the total net PIP amount is negative? Let's say if by the end of the month you have a negative PIP amount of 100 minus 100 pips, is it possible to have a growth in the equity, to have money accumulated in your account despite of a negative PIP sum? It's possible. I think we have 3A and 2B. Okay. Hopefully we have time to see an example of that. We are good in time. We have just half an hour left, and we are almost finished with the questions. 13 of 16, what happens to the amount of capital risk in a fixed fractional position sizing model? The amount of capital risk increases as the available capital grows. The amount of capital risk decreases as the available capital grows. C, the amount of capital risk varies independently to the available capital growth. So we have a fixed fractional and the capital risk, the amount of money we are risking, does it increase, which is answer A, or decreases, which is answer B, or is it independently of the equity growth? Okay, we have three answers for A. Okay, let's move on. 14. Which position sizing model makes trading results very much dependent on whether the system continues to work or not? So there are certain position sizing techniques which makes you, the trader, very dependent on the system's performance. So you rely on the system's performance, and you have not really an aid from the position size technique. You cannot use it to manage, to enhance, or to control those results. It's not said that you can turn a losing strategy into a winning one, but there is a technique which makes you more dependent on the system's performance than others. The effective cost is a technique which we haven't covered during the last webinar. It's explained in the Learning Center. But we have the fixed lot. We covered the fixed lot. We covered also the measured fixed fractional, and we covered also the fixed. No, we didn't cover the fixed ratio. That was part of the Learning Center. Let me show you for a moment what is the measured fixed fractional. I jump here to the. One second. Okay. Here we have the measured fixed fractional, the pros and the cons. Basically, what the measured fixed fractional does is we are still working with a fixed fractional, so the calculation is basically the same, okay, as in the classical model. Here the difference is you recalculate the size only after an increase or decrease of the account by a certain amount. Okay, that amount you establish a priori. You set an amount of you can measure that in increments of an equity growth, each $100, each $1,000 increase in your account, for example, or you may measure these increments in the percentage of your account growth, or you measure it in increments of different types. You can define it through the core equity, total equity, or reduced core equity. Different definitions of how equity can be defined. Okay, basically the table that we see here on the left side increases the lot size, or recalculated the position size each time the account grows by $1,000. Okay, each $1,000 it's recalculated, so that measured fraction is established, and each time the account in that case grows from 11,000 to 12,000, there is a recalculation. You see, from the 1% risk, so we establish that 1%, and that stays fixed all the time, and that 1% is dependent on or is recalculated each time the account grows by $1,000. Okay. If there is a decrease in that amount, so basically we go to the measure or to the measured fraction we had previously fixed. Okay. So if the account reaches 12,000, we recalculate the position size, but if there is a loss or a series of losses and the equity goes beyond that threshold to 11,000 again, or to slightly below 12,000, we use the 11,000 again as a reference, as a measure for the fraction. Okay. We can see here this is basically from our testing, from the strategy, showing when the position is increased and decreased. And we see the equity curve here. It's not anymore this exponentially ascending curve, but you can cut a bit that dynamic of a rapidly ascending curve. See also the results are more smoothed than in the pure model. Okay. Also, the statistics will show you the standard deviation, which is much lower than in the pure fixed fractional. Okay. Basically, it smooths the equity curve. It's one of the advantages, and it simplifies calculations as well, because you don't have to recalculate the position size after each trade. You do it only after the account increases by a certain amount. Okay. Okay. It allows also faster drawdown recovery, because you are not reducing your position size after each loss. You only reduce it if you go beyond the fixed measure. Then you recalculate. If not, you maintain the same position size, and that helps to recover faster from a drawdown. Okay. As a disadvantage, we may say that the leverage is not constant, because although you are in fact risking a fixed percentage of a certain measure, but that measure does not correspond to your account, because the account grows from one measure to the other or decreases, and in between the leverage will be not very constant. But this is a relatively little variance here. It's we pointed it out as another disadvantage, but if that measure is not very big, so the variance in the real leverage will be not significant. Okay, and as a disadvantage, we can also say that aggressive traders may not profit from the compounding effect, from that anti-martingale effect of adding to winning positions. So even if you are winning and adding some results, positive results to your account, the position size is keeping the same until you reach the next measure. So by keeping the same account, by keeping the same position size, you are not profiting from compounding. Okay. Only until you reach that new measure. Okay. Like here, once you reach new measures, or at the bottom of the table, for example, we see the account jumps from 13 to 21. So basically, here you recalculate the 1% risk accordingly to measure or benchmark, which is 21. So you jump several levels. Alex says 1% plus how many pips? Well, you can do it basically. You can do it by percentage, or you can do it by dollar amount, for example, or it depends on the currency your account is used. I'm not sure if I understand your question. Is the 1% risk is basically for a loss. Well, if there is a loss, you keep that account size until you reach the previous measure, so to say. Okay, if your account grows to 21,000 and you go back to 13, you recalculate it as your account would have $13,000. So you calculate 1% of that until you reach 14,000. So if you are at 13,500 in the calculation, you still have an account of 13,000. Okay. I hope this answers to the question. Let me just jump again to the exam module. 1 second. Okay, here. All right. So the question was addressing which model makes trading results very much dependent on whether the system continues to work or not. I've seen that we have answers. We have here we have two times B. So I guess B is the answer the majority has chosen. Okay. Let's then submit the question. And the next one asks, suppose we have a system trading the euro dollar with 1 minute lot and averaging 10 pips per trade. After the first 100 trades, the account grows by $1,000, which is a return of 100% on a $1,000 account. Between the 900th and the 1000th trade, the system registers only a 10% gain. What money management model is being used? We are doing the same amounts of pips, but there is a different gain. Is a different gain with an account with $1,000 or with the first 100 trades, then after 900 trades. Which model or which technique is being used here that despite a same gain, the percentage gain has been less. So the impact in terms of percentage has been less. Is it a fixed fractional? Is it a fixed lot? Is it a measured fixed fractional? Or none of the above? Do we have answers for this one? A, fixed fractional. We have D, none of the above. And we have also a B, a fixed lot position size. If you trade always let's suppose you trade always a fixed lot. Okay? If you trade a fixed lot, you trade 1 mini lot, okay? And your account is now at $1,000. Okay, number B. Answer B. All right. And the last question, which money management models allow the compounding effect to kick in every time there is a series of winning trades? So which models allow for the compounding effect? We have said that that anti-martingale type of techniques are profiting from the compounding effect, each one at a different speed, but all they profit from the compounding effect. So we have here, let's say, A, B, C, and D. A, C, and D. We have here A, C, and D. Okay. Anyone wants to add to this? Okay, this is the last question. So we submit the answer, and let's see, we passed the exam with a score of 82%. Congratulations, everyone, for the excellent results. Let's review here briefly and see where we have eventually failed. So we have this, the first question, which said the fixed fractional model is a martingale money management technique or an anti-martingale. We typed B and sorry, I have here review. Okay, let's say we have typed answer B, and it says that a martingale money management technique, the fixed fractional, which is obviously an error from the system, I think. One interesting aspect, says the explanation of the fixed fractional model, is that since the size of the trade stays proportional to the equity, it is theoretically impossible to go entirely broke, and therefore the official risk of total ruin is zero. The risk is the same percentage of or fraction of the account equity on each trade. By risking always the same percentage or position size, the risk fraction stays proportional to the equity while the equity rises and falls. This is thus an anti-martingale. So I guess this is by typing the answer. So we have, I guess we choose the anti-martingale and either the system was wrong or we typed it wrongly. But I guess we understood that one. Let's see another one which we haven't answered right. An arithmetic curve. Okay. An arithmetic curve. A geometric capital growth is produced when profits are reinvested into trades, which leads to progressively larger positions being taken and consequently to bigger profits and losses. Okay. So we selected the wrong curve. This is one of the advantages of the retail forex industry. The small trade sizes allowed. Without it, the growth of small accounts would be much more difficult. Okay, so an arithmetic curve is this one. Let's see if we have further failed questions here. No more failed questions. let's go over some of the questions. You see which type of money management models favors a more rapid recovery from a drawdown. Martingale models, okay? When using an anti-martingale technique like the fixed fractional position size, the reduction of the relative position size after every loss makes it more difficult to recover from a severe drawdown, okay? Martingale techniques, in turn, enlarge the position size after each loss. The fixed lot size, for instance, has this kind of effect because by keeping the size constant, its size becomes relatively larger to the equity size. Okay, so that is why by trading a fixed lot size, theoretically, you recover faster from a drawdown than with a fixed fractional. Although the fixed lot size is not a martingale technique in itself. Okay. This is the formula to calculate the position size. Usually we see this formula where we can see the counter value, the risk per trade, and the pips, the number of pips risked, but we rarely see the last part of the equation, which is the pip value, because if you want to fine tune your position size in any of the fixed fractional models, you should add the pip value. Because if you are trading, for instance, with a dollar-denominated dollar quoted pair, it's easy to calculate because finally a pip is worth $1 or $10 depending on the lot size. But if you are trading process like the Euro Swiss, for example, or the sterling yen, it's usually we suggest to include the pip value since these pairs can vary a lot in their pip value. Okay, the pip value, for instance, in the sterling yen, it was not the same in 2009 and it is now than it was 4 years ago. So the pip value is changing with time, depending on the quote, and that makes also the behavior of each pair conditions the behavior, because if you if you have euro sterling, for example, in terms of dollars, that the pip is more worth than in any of the majors, so that it conditions a lot the behavior of this pair. Okay, if you have a certain amount to risk per trade, it's not the same risking 20 pips now than risking 20 pips a year back or 2 years back, where the pip value is different. Okay, so the stops are readjusted accordingly to the pip value, and that affects as well the behavior of that currency pair. Okay, and if you want to, as for position size, if you want to fine tune that calculation, so you should add the pip value to the formula. Okay, we have a few more minutes, just previewing here the answers. Some traders perform poorly if their accounts start to grow exponentially. So we have answered here the fixed lot money management. The fixed lot money management allows profits to grow arithmetically, that is, by a constant amount per time period. It is useful, for instance, if you withdraw your profits after each month of trading to start anew with the same capital. It is also useful if you prefer to trade with a large account and withdraw profits regularly, not aiming at growing the account. Okay, So you might combine different types of techniques. You may choose to start with a fixed fractional, with a classical model, and once your account grows, you may say, now I change to a measured fixed fractional, or I change to a periodical fixed fractional in order to cut a bit that exponential growth of my curve. So you may change your position sizes techniques from accordingly to your account growth or to the condition where you are in, because several or some techniques, for example, the fixed ratio, as we have here in one of the answer B, fixed ratio. Fixed ratio is ideally is very suited, for example, if you have to participate in a competition with a small account size and risking a lot in relation to your account size, but at the same time also using a type of anti-martingale technique. So the fixed ratio would be ideally suited for a competition, for example. But once you have an account which has grown to a certain amount of capital and it is producing the income that you need on a regular basis, you may switch to a fixed lot, for example, to a fixed lot technique. So from there on, you trade exactly the same amount. Okay. Yeah. So you may jump from question 12. Sure. Let's look to question 12. Let me see here. 1, 2, 3, 4, 5, 6, 7, 8, 9. This one, does the fixed fractional position size model remedy the problem of equity drifting out of proportion in relation to the fixed lot size? I guess it's this one. And the explanation says the fixed fractional model defines the trade risk as a fraction of the equity. This is a model that directly incorporates trade risk. The idea behind the fixed fractional model is that the number of traded units based on the risk of the trade. The risk is the same percentage or fraction of the account equity on each trade. By risking always the same percentage or position size, the risk fixed fraction stays proportional to the equity while the equity rises and falls. Okay. All right. So I think we have 2 minutes left. I don't know if there are more questions. We may switch here to have a last look here to the links and references. There are several books which you may find interesting. Fantarp explains a lot about position sizing models and the concept behind it. Also, Alexander Elder goes into the topic, and for more advanced users, Ralph Vince in Portfolio Management Formulas also writes about the topic. So basically, what we covered, we have also one of the techniques we haven't talked about is the splitted version that we may talk about it in further occasions in future webinars, and also definitions of trading equity and so on. I guess all these you can find it in the Learning Center. You are welcome to send questions if you have any. This is my email. Any questions on the topic, and I'll be glad to answer them to you. I hope you enjoyed. Hope you learned something new, and let's think of the next webinar on the trade plan series. Thank you very much for your attention, and have a nice evening. Have a nice day.